On the 20th of September 2023, the Federal Reserve left its interest rate unchanged. On the 13th of December, it did exactly the same. Both times, the target range stayed at 5.25% to 5.5%. Read only the first line of each announcement and you might mistake them for the same decision. They were not. In September, the message was that the economy was strong and that rates might have to stay high for longer. By December, the Fed had brought the prospect of rate cuts much closer. Treasury yields fell sharply, equities rose, the dollar weakened, and yet the rate itself had not moved. What had changed was the future attached to it. This is the first thing to understand about the Federal Reserve. A meeting does not simply set an interest rate, it reprices the future. The committee meets 8 times a year. At every meeting, it announces a target range for the overnight rate. And 4 times a year, it also publishes projections for growth, unemployment, inflation, and the rate itself. So the visible output is a single number, but the economic output is a vector. It carries the action taken today, the likely path of policy ahead, the committee's diagnosis of inflation and growth, the evidence it would need to move again, the risks it is most afraid of getting wrong, and the future course of its balance sheet. Markets have to interpret all of it at once. A decision to hold rates can be restrictive if the Fed signals that cuts are further away. A rate hike can be received as relief if investors had feared something larger. And a cut can even tighten conditions if it makes markets fear that inflation will now run hotter for longer. So policy is never measured against yesterday's rate. It is measured against the future already embedded in prices. Consider a 10-year Treasury bond. Its yield is not one rate. It is the expected average path of short-term rates plus a term premium, the compensation investors demand for holding a long asset whose value can change. Cut it another way, and the same yield is a real yield plus inflation compensation. This is why a 10-year yield can rise after the Fed cuts and fall after it raises. If investors conclude that inflation will be tolerated, the inflation piece rises, and the whole yield rises with it, even as policy eases. Not all of these pieces can be seen cleanly. The term premium is only estimated through models. But the distinctions matter because each one describes a different economic change. Bond traders are not trading one rate, they are decomposing a future. And equity investors receive the very same meaning through another calculation. A company is worth the present value of the cash it may earn in the years ahead. When real yields rise, that discount rate rises and distant profits become less valuable today. But the meeting may also reveal something about the profits themselves. A message that sounds hawkish can mean the Fed sees demand as stronger than investors assumed, which lifts the earnings outlook even as the discount rate rises. So the same announcement can send a market up after a hike or down after a cut. It is never simply good news or bad news. It is new information set against the future that was already paid for. Economists listen for something even less visible. They listen for the Fed's reaction function. What evidence would justify another move? The dot plot seems to answer that, but it is often read as something it is not. Each dot is one participant's own judgment, under that participant's own forecast. It is not a committee promise and not a timetable. And the medians, for the rate, for growth, and for inflation, are each computed separately, so they may belong to no single person. Between September and December of 2023, the whole cloud of dots drifted downward, and the median for the end of 2024 fell from 5.1% to 4.6%, roughly 3/4 point cuts. The rate had not changed. The forecast had. The Fed changes a policy setting. Contracts decide who actually feels it. 2 banks can receive opposite shocks from the very same announcement. Silicon Valley Bank made that visible in 2023. During the low-rate years, it had loaded up on long-dated fixed-rate securities and funded them with concentrated deposits that were about 94% uninsured, free to leave almost instantly. As rates rose, the market value of those securities fell. That loss lived only on paper, so long as the bank held them. But when depositors began to run, the bank had to sell, and the paper loss became real. On the 10th of March 2023, it failed. Higher rates did not create every weakness. They revealed which bank had let its survival depend on funding that was never questioned. And notice that the effect changes over time. Higher rates can first improve a bank's income. Then depositors demand more, funding turns expensive, borrowers weaken, and late payments appear. What looked like a margin benefit slowly becomes a credit problem. Companies feel the same clock. A firm with 10-year fixed debt may feel almost nothing today, while another meets the new rate at its next refinancing more than a year away. The rate that matters is not the one the Fed changed, it is the one your contract is about to meet. Housing shows the same force acting on both sides of a market. A 30-year mortgage rate is not the Fed's rate. It also depends on long-term yields, on expected policy, and on lender margins. But once it rises, it changes more than affordability. Picture an owner with a mortgage fixed at 3% when a replacement loan would cost nearly 7%. To move house now means surrendering an unusually valuable contract, so the owner stays. This is mortgage lock-in, and it removes both sides at once. Higher rates reduce the buyers who can afford a home, and they reduce the owners willing to sell it. Sales collapse while prices stay surprisingly firm. Federal Reserve research estimated that lock-in explained 44% of the fall in mortgage borrower mobility from 2021 to 2022. And developers face their own clock. Their financing has to bridge the years between buying land and selling the finished homes. If that money becomes too expensive, the project is simply never built. The near-term result is fewer sales. The later result is less housing supply. Then the dollar carries the whole revision abroad. Because the dollar is not only an investment currency, it is the world's funding currency. Borrowers outside America issue debt in dollars. Banks lend across borders in dollars. Roughly half of all cross-border loans and about half of global trade invoicing are in dollars, even though the United States is only about a quarter of world output and a tenth of world trade. So when the dollar strengthens, it tightens financial conditions far beyond America, and a foreign central bank is left with a menu of unattractive choices. Raise its own rates? Let its currency fall? Import more inflation? Spend its reserves? Or tolerate capital leaving? The Fed sets policy for the United States. The dollar makes every other country answer it. And yet, the reason for the move still matters. A pure tightening of policy can weaken foreign credit and asset prices, but a higher yield that comes from unexpectedly strong American demand can actually help exporters selling into the United States. No country feels the Fed in isolation. It feels the meeting through its own currency, its reserves, its trade, and its debts. But the physical economy sets a hard limit on this power. Higher rates can weaken the demand for oil and metals. They cannot create the supply. Oil still depends on wells, and copper on mines that can take years to approve and build. No interest rate can conjure a missing barrel or a missing ton. And there is a sting in the tail. A higher cost of capital makes those very projects less attractive to build. So policy can restrain demand today while raising the hurdle for the capacity the world will need tomorrow. A central bank can reduce the demand for scarcity. It cannot vote scarcity out of existence. And for a country that imports its energy and its metals, the pressure can arrive from 3 directions at once: a higher commodity price, a stronger dollar, and a higher cost of finance. The result can be slower growth and higher inflation at the very same time. And there is no average recipient of monetary policy. One stance lands on countless different balance sheets. A saver earns more. An owner with a 3% mortgage barely feels it. A first-time buyer is priced out at 7%. A small business that reprices every quarter is squeezed, while a giant that fixed its debt years ago is untouched. Time separates them even further. Bond yields move within seconds. Mortgage quotes change that same afternoon. A floating loan resets next month. A company refinances next year. Construction jobs fade later still, and defaults may not appear until borrowers have exhausted their savings. By the time the damage is visible, inflation may already be falling, and the Fed may be turning the other way. An average effect may describe no actual person, so the useful question is not simply whether the Fed helped the economy or harmed it. It is this: Who is absorbing the adjustment? Through which contract? Over what period of time? And what would probably have happened if policy had been different? So how should you read the next meeting? Ask 4 questions. What had markets already priced in? Which part of the vector actually changed? The rate, the path, the diagnosis, or the balance of risks? Was the surprise mainly a policy action or new information about the economy? And which contracts and which balance sheets will meet the revised price first? Because the full sequence is always longer than the rate decision. Expectation becomes revision. Revision becomes price. Price meets exposure. Exposure changes behavior, and time reveals the consequence. So return to those 2 meetings. In September, the Fed held and stretched out the expected period of high rates. In December, it held and brought the cuts closer. The visible decision was identical. The economic event was not. The committee does not directly command a 10-year yield, a bank deposit, a corporate loan, or a currency on the far side of the world. It changes one shared expectation about inflation, growth, and the path of policy. Markets convert that expectation into prices. Contracts decide where those prices land, and time decides when. What happened on both days was that a committee left an interest rate unchanged. What was actually operating was a repricing of the future across balance sheets around the world.